New York, The Street. BlackBerry, BBRY, Get Report. Shares are up 0.25% to $7.98 in morning trading on Monday after photos leaked of the smartphone and mobile software manufacturer's newest Android-based smartphone model, Venice. The Venice touchscreen smartphone will feature a slide-out QWERTY keyboard based on the pictures that were leaked by Evan Blass under his Twitter, TWTR, handle @EveLeaks. The phone will be sold exclusively by AT&T, initially, according to Blass, and will reportedly come with a 5.4-inch screen and 18-megapixel rear camera. The Street Ratings team rates BlackBerry Limited as a seller with a ratings score of D. The Street Ratings team has this to say about their recommendation. We rate BlackBerry Limited, BBRY, a sell. This is driven by a few notable weaknesses, which we believe should have a greater impact than any strengths, and could make it more difficult for investors to achieve positive results compared to most of the stocks we cover. The company's weaknesses can be seen in multiple areas, such as its weak operating cash flow and generally disappointing historical performance in the stock itself. Highlights from the analysis by The Street Ratings team goes as follows. Net operating cash flow has significantly decreased to $134 million or 55.62% when compared to the same quarter last year. In addition, when comparing to the industry average, the firm's growth rate is much lower. BBRY has underperformed the S&P 500 index, declining 23.77% from its price level of 1 year ago. The fact that the stock is now selling for less than others in its industry in relation to its current earnings is not reason enough to justify a buy rating at this time. The company's current return on equity greatly increased when compared to its ROE from the same quarter 1 year prior. This is a signal of significant strength within the corporation. Compared to other companies in the computers and peripherals industry and the overall market, BlackBerry Limited's return on equity significantly trails that of both the industry average and the S&P 500. The revenue fell significantly faster than the industry average of 32.8%. Since the same quarter 1 year prior, revenues fell by 31.9%. The declining revenue has not hurt the company's bottom line, with increasing earnings per share. Despite currently having a low debt-to-equity ratio of 0.44, it is higher than that of the industry average, inferring that management of debt levels may need to be evaluated further. Even though the debt-to-equity ratio shows mixed results, the company's quick ratio of 3.28 is very high and demonstrates very strong liquidity. You can view the full analysis from the report here, BBRY Ratings Report.